Okay, let's talk about the global cues. Here's Nigel with the world view.
Well, the U.S. markets were shut yesterday, as we know, because the country was mourning the loss of President H.W. Bush. So the funeral was there yesterday. So today, in fact, data that was due yesterday will be out today. The ADP jobs data, as well as the Labor Department productivity report. So that's something that the U.S. markets will be looking at as well. But President Trump, he was very, very active on Twitter yesterday. He's indicating, and he's quite optimistic, that China was going to go ahead and restart buying soya beans as well as LNG. Well, later on, he put on another tweet and said, yes, they've agreed, and they're going to be, going ahead and buying some of the U.S. products. So positive signs coming out of there. But we'll have to keep in mind that the Chinese, they're going according to the plan. But what will President Trump's reaction be? That's something that we'll have to keep in mind. Though he's sounding optimistic, we'll take that for now. The European markets, though they ended in the red, all the three frontliners, they ended with cuts of around 1%. The building products business, the material businesses out there, they took a sharp knock in trade yesterday. But you're looking at some economic data. Well, you had the retail sales numbers that looked better than estimated. In fact, in yesterday's trading session, online sales as well looked quite good. So that was a positive data point coming in from the Eurozone. But otherwise, all eyes on crude oil prices. And President Trump was again on Twitter. He's saying that, in fact, he doesn't want higher oil prices. So that, in fact, we'll have to keep in mind. Remember, today is the big OPEC meet. So all the nations will be meeting today. Brent crude prices for now, $61.50 per barrel. But Asian markets, they're not in a great space. All of them down between 1% to around 2.5%. SGX Nifty as well is indicating a cut of around 80 points to kickstart trade. Back to you all.
Thank you very much for that. And that's what we're going to keep our eye on, Nigel. And we have a very important global voice to help us parse this global scene. Shane Oliver, Head Investment Strategy and Chief Economist of AMP Capital Investors, joins us on the phone line. Good morning, Shane. Thank you very much for joining us. I mean, this growth scare, to some extent, has come out of nowhere. We've had a string of good data coming out from the United States, and then we had Jerome Powell admitting that the neutral rate, he hasn't got much to go to the neutral rate. And then we have the yield inversion. Is there really a very big growth slowdown in 2019?
I don't think there is. And I think this talk about a yield inversion is wacko or crazy. I've never looked at the gap between the 5-year bond yield in the US and the 3 or the 2-year bond yield. I've always, when you look at the yield curve, I like to look at the very long-term bond yield, the 10-year bond yield, and the Fed funds rate. And I think a lot of this focus on the yield curve in very shorter, detailed sort of analysis is probably over the top. Historically, yes, it has been a concern when the yield curve flattens. But once it inverts, it can be up to 2 years before the US economy goes into recession. So, yes, there's an issue there. The yield curve is flattening. But by the same token, I think these growth concerns are way over the top. If you look at the ISM index, consumer confidence, consumer spending, all those numbers, unemployment, they all look pretty good. They're not indicating an imminent US recession.
Okay. Shane, hi, good morning. The theory is wacko. I haven't heard that word on national television in a very long time. But thank you for bringing the casual spin on it. Ahead of the OPEC meeting, anyone and everyone has suddenly become a crude expert. But you tell us what your view is, because, in the production policy, there is a view that a supply cut would be announced, to drain the glut that we've seen in the system. If that takes place, do you think crude prices would move higher? And what would the repercussions be on an oil importing nation like India?
That's a good question. And, of course, it impacts where I am in Australia as well. We're not an oil importing country. We do import oil, but we also export gas, and the gas price is frequently tied to the oil price. So Australia probably, our exporters probably want a higher price, if anything. My feeling is that this, something like a 1 million barrel per day cut in production is largely factored in. So if we get a cut in production which is less than that, I don't think it's going to have much upward pressure on the oil price. If it's around 1 million barrels per day, it shouldn't be a surprise. If it's greater than 1 million barrels per day, then we might see a bit of an uptick in the oil price. I think the complication in this environment is that obviously the sanctions on Iran haven't proven to be anywhere near as severe as had been feared. And in the meantime, production in the US is going through the roof. And, of course, global demand has slowed down, all of which has, of course, caused the oil price to collapse. My base case would be we'll get the 1 million barrel per day cut in production. There'll be question marks about whether OPEC is sticking to the deal or not. I think there's some talk that Qatar is thinking of leaving OPEC, maybe even Iraq as well at some point. And that in turn, I think will probably be just enough to keep the oil price around current levels, around $54, $55 a barrel.
Okay. Shane, good morning. Following the action from Adelaide? If you are a cricket fan, since this India-Australia Test series happening, I just thought that I'll ask you if you're following that action over there. But so for Indian market, you reckon there's going to be this recent outperformance that we have seen that can continue, or is there risk that because we've outperformed so much, especially in the near term, the market becomes vulnerable?
Yeah, that's interesting. India has outperformed. Its economy looks a little bit more resilient than other economies, and that was evident in the PMI readings that came out earlier this week. They look quite healthy for India. In fact, the composite yesterday looked very healthy. So it's quite possible that the Indian share market, yes, it's a bit short-term overbought in terms of relative performance, could go through a brief corrective period. But I think in the biggest picture sense, India probably will do reasonably well. It was caught up to some degree in that weakness in emerging markets earlier this year up until recently. But I think India is in far better shape than many other emerging markets. And I'd be reasonably optimistic about the outlook for the Indian share market. Obviously, what goes on globally will have an impact in sentiments, and I think it's still too early to say that we've seen the bottom in share markets globally, but in a relative sense, I'd be optimistic on India.
So you think this big bear wave that we saw and this over-interpretation of the wacko yield curve inversion is perhaps only for the near term, and we're going to find some support probably when the non-farm payroll numbers come or the Fed meeting? Do you think the global financial markets are going to overcome this sometime soon?
I think they will. I kind of think that investors are so twitchy that you put anything up there that sounds negative, they'll latch on to it. Yesterday or the last couple of days, it was this, we'll call it the wacko yield curve analysis. And then, of course, no one was talking about that before, but suddenly everyone's talking about one little itsy-bitsy part of the yield curve. And then today, we've seen this focus on the arrest of an executive from Huawei, if I pronounced that right, the Chinese company, Huawei. And maybe that's going to increase tensions between the US and China. Tomorrow will be something else. So investors are just twitchy out there, and they just tend to latch on to any negative news story to push the share market down. But the underlying situation, I think, is a lot sounder.
Okay.
And at some point in time, investors will say, yeah, the data's good. The Fed looks like it might have a bit of a pause, and then we'll start to see markets heading higher, and hopefully that will occur before the end of the year.
Okay, so are you a cricket fan or not, Shane?
I'm not a big cricket fan. I tend to be a bit impatient with the sports I watch, and cricket goes on for too long.
Okay, because when you said India is resilient, I thought you meant India is resilient against Australia in the first test. But I get your point. You meant India is resilient as a market. Thanks so much for joining us and giving us your take on
resilience in Adelaide. 4 wickets down now. It was so bad getting up in the morning and watching 19 for 3. And now,
some things don't change. When late 80s, it was the first time that cricket was actually live on television. Earlier, it used to be only on radio, right? And you would wake up and see. Those times there were Bruce Reid and I think Craig McDermott used to run havoc. And now even Mitchell Stark and Josh Hazelwood. Kohli got out to a really sensational catch, but. Anyway, we still have hopes, I think.
Yeah, I know, it's only
first morning of a four test series.
I think it's also about patience, right? As he said, yes, IPL has ruined it.
Yeah, I think Sunny Gavaskar was making this point that, there's too much T20 and, one-day cricket just ruined the Indian cricket.
All right. We've got more opinion on markets as well. Stephen Parker of JP Morgan Private Bank says he expects the equity upsides in the future. So that's another bullish voice.
The yield curve has been a great indicator about the potential for recession, but not necessarily a great indicator around what you should do from an asset allocation perspective. stocks generally rally over the last 7 or 8 cycles for the year after the yield curve inverts. And on average, you've seen 20% gains within equities. So we're not making wholesale changes within our equity allocations, but rather taking in some of the risks that we're seeing on the fixed income side of portfolios. And there's a risk-reward trade-off, right? On the upside, we think that if things turn out better than expected, the upside you're going to get from equities is much better than what you're going to see from corporate credit. And on the downside, I'm not so sure that the defensive nature of high yield, and especially some of the lower credits, is going to protect you as much, even in an equity downdraft.